Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we're diving into a report from the Federal Home Loan Bank of Dallas. Don't worry, it's not as boring as it sounds. Think of it as a financial health checkup and we're the doctors, except instead of stethoscopes we have SEC filings. This report is all about debt and whether Uncle Sam is on the hook. The answer might surprise you. Before we jump in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can join other Corporate Decoder fans. This report is a current report, also called an 8K, which was triggered by an event that happened on July 1, 2025. This means the bank had something important to tell investors right away. The report was officially filed a few days later on July 8. The main point of this report is to talk about the bank creating what they call a direct financial obligation, which is a fancy way of saying their securities, which are like IOUs called consolidated obligations. These are basically bonds and shorter term notes issued in the market. To be clear, it's not just the Dallas Bank doing this, it's a joint effort by all 11 federal home loan banks. They all promise to pay these debts together. Think of it like a group of friends co-signing a loan. Here's a very important point. The report emphasizes that these consolidated obligations, these debts, are not backed or guaranteed by the United States government. They are only backed by the financial resources of the federal home loan banks themselves. So if the banks run into trouble, the government isn't automatically stepping in to pay off these debts. Now, the report gets specific. Schedule A, the main table, summarizes all the bonds that the Federal Home Loan Bank of Dallas is responsible for issuing. It lists things like the date the deal was made, the date the bond matures or comes due, and the interest rate. Remember that while it includes debts the bank assumes from others, it does not include short-term debt 1 year or less. The report also includes some disclaimers which are worth keeping in mind. First, the bank says it hasn't decided whether these bonds are actually important or material to investors. Second, the schedule doesn't include any information on interest rate swaps or other financial instruments the bank might be using to manage its risks. Third, the information doesn't give you the full picture of the bank's total debt because it doesn't include the short-term notes. And last, the amounts listed may not match the numbers in the bank's financial statements because of accounting adjustments. Let's dive into that Schedule A, which is where things get interesting. The table lists a bunch of bonds the bank committed to, so let's look at some key numbers. Starting on July 1, 2025, the bank committed to issuing a bond with the code 3.30B6XL5. It matures on July 30, 2026. So it's a little over a year-long bond. The initial coupon rate is 4.190%, meaning that's the interest the bank will pay on this bond. The par amount or the face value of the bond is $150 million. Another bond also from July 1 matures later on July 1, 2027. The interest rate is a bit higher at 4.375% and the par amount is $1 terms, maturing in 2027 and 2030 with interest rates between 4.7% and 3.920%. But there are interesting floating rate bonds to consider also. Finally, notice that there are two very large bonds issued on July 3, maturing in early 2026. The first is $125 billion $13 with the code 3130B6YD2, and the second is $500 million with the code 3030B6YP5. What's interesting about the rates, they are variable, with one being based on overnight SOFR, other being overnight SOFR, plus 0.015%. The report also explains some terms like call type, which describes whether the bank can redeem the bonds early. There are descriptions of those. It defines terms like American, Bermudan, and European, which are different styles of call provisions or early redemption options. It explains different rate types. For instance, there are fixed bonds that pay a constant interest rate and variable bonds that adjust based on a benchmark rate. Now, let's step back and look at the overall picture. The Federal Home Loan Bank of Dallas is actively borrowing money through these consolidated obligations. The interest rates vary depending on the maturity date and other factors. The bank is taking on a significant amount of debt, and it's important for investors to understand the terms and risks. One key takeaway is that these debts are not backed by the US government, meaning there's a higher level of risk involved. The floating rates are also of interest as these represent shorter term thinking, and the variability comes with both risk and rewards. So what's our take on all of this? The Federal Home Loan Bank of Dallas appears to be managing its debt obligations in a pretty standard way. They're issuing bonds to fund their operations. But remember the risk that these bonds are not government backed. The amounts they are borrowing are substantial. What's important is the bank's ability to repay these debts, which depends on the overall health of the housing market and the economy. Looking at the report, a possible concern is the reliance on debt, especially the floating rate notes, which might put pressure on their finances if interest rates go up. So while the bank seems stable, investors should keep an eye on these factors. Alright, that's our breakdown of the Federal Home Loan Bank of Dallas's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.